Thank you, everybody, for tuning in to this latest episode of Coffee with Bob. We have our cups of coffee here. Well, mine is tea, per usual. Derek, it looks like you have your cup of coffee.
I do.
We got to get you an H&A mug, though, Derek.
Yeah, but this is one of my favorite mugs. This newer.
Okay, well, we'll get you
one of my favorite places on earth.
You know,
good.
Drinking your favorite caffeinated or decaffeinated beverage out of your favorite mug just always makes it taste a little better. So
there's no doubt.
Yeah, I appreciate that. Again, thank you everybody for tuning in today. Let's talk year-end tax planning, and specifically this year, how those tax planning efforts could be affected by the results of the election. We already have the presidential election results with President-elect Joe Biden. Now, there are some legal battles ahead for both of the campaigns, and we'll see where that turns out. The markets are starting to continue to price in the idea of Republicans keeping Senate control. So we're going to talk about all of these things in more depth with Derek and go through what those issues, those scenarios can mean for your year-end tax planning. A couple of housekeeping items before we get started, though. So H&A has a YouTube channel where you can watch all past episodes of Coffee with Bob and any future episodes as well. As we broadcast, right after we do so, we get them up onto YouTube so that you can watch those at your leisure. Just search Hapanowitz and Associates YouTube on Google and it will take you right to our channel. And I mentioned this in the last episode, but we have our private label Coffee with Bob. And we're also ordering some Coffee with Bob mugs as well. So stay tuned for some giveaway opportunities. And Derek, you better be sure that you're going to be receiving one of these as a thank you for coming on today. Today is November 11th, and it's a special day for a couple of reasons. One, it's Bob's birthday. So Dad, happy birthday.
29.
And November 11th, 2020 is also Veterans Day, and it's a special holiday for us. Both of my grandfathers served in the military during World War II. Mm-hmm. Grandpa Hap, your dad was a bombardier in World War II. So from all of us here at H&A, on behalf of Derek and his team as well, we just wanted to say happy Veterans Day and a huge and heartfelt thank you to all veterans for their sacrifice. We're truly indebted and we're really grateful for your service. Okay, so let's dive into it. Bob, I will let you officially introduce Derek.
All right, so Derek is CPA extraordinaire, first and foremost. The thing you should know about Derek is he and I both like to drink bourbon. So that's how you unwind a little bit. We enjoy that, and hopefully we'll do that again soon. So Derek is he's a as I mentioned, CPA extraordinaire, consultant to business owners, understands the tax code inside and out, understands political ramifications, how that's going to, potentially affect some of the things that we're going to talk about today. And with that, my friend Derek, Christina, I'm going to hand it back to Chris, and we're going to get started here with a couple of really tricky questions.
Derek, thank you again for joining us.
My pleasure.
Your very busy schedule. Thank you. Before we dive into these questions, if you could just give, the audience a background as to your career path and how you got to where you are today.
Yeah, I definitely took the path a little less traveled. I was an economics major at University of California, Berkeley. Went to Israel for a year after college. Got a job in an engineering firm in their accounting department and kind of realized I liked this stuff. And so ended up moving to Pittsburgh in '97, got a job at a public accounting firm. In 2003, started my own practice. In 2012, merged into Markovitz Dugan as a partner. Markovitz Dugan, we are what I would call a full service accounting firm. We do tax work, financial work. We have a really strong bookkeeping arm. Two of my partners are JD CPAs. We do business valuations, cost segregation studies, R&D credits. So we're kind of, the full service gamut. But I'd say the one commonality is that we usually do it for small business owners. We have businesses that are, and I guess small is a relative term in this day and age. We do have, a couple of businesses that are over the $200 million range. But we have most of our businesses probably fall between the $1 million and $50 million range. So a lot with clients, small business clients on their tax planning. I was like going to say kind of, this is great that you had me on because this is kind of my favorite time of the year. I guess maybe a little as a tax nerd. When we get to the point of doing a tax return, everything's been done. Everything's been decided. There's not much I can do to help a client. But this time of year is where we can really affect a return, make changes, and we'll talk about some of the things in Biden's tax plan, which really kind of affect that because it's always exciting when that happens and scary all at the same time. I personally do over 100 tax plans during the next month and a half. I'll do over 100 tax plans for clients trying to figure everything out. One of the things we say all the time, or I say all the time, I said, I never want to say to a client, did you know? Did you know you're going to owe $50,000? Owing $50,000 is great. It means you made a lot more money this year than you did last year. Not being prepared for it, not so good. So we're really excited. We always love this time of year because it really can affect change and meaningful for some clients. So.
Absolutely. And so Derek and our team, we have a number of mutual clients that we work together on. And yes, to your point, it's always a really great time of year to, have those conversations with you. So we really recommend everyone watching this, work with a team of advisors that are working together, because that's when you get the most out of their services and the most out of your investments in your portfolio. We can't speak to that enough. Derek, thank you for giving that background. You have countless years of experience, in this industry. And I'm sure this is not the first time at the rodeo for you when it comes to trying to figure out what potential tax law changes, might be coming our way. I mean, what do you think of all of this right now?
Well, I mean, it's certainly an unusual time. We went from having, 8 years of Obama, who's a Democrat. It's, Democrats have a certain, definitely a certain tax plan in their mind, to 4 years of Trump, who had a certain tax plan in mind and was able to implement it because he did have a Republican Congress when he did it. And now we're shifting back to a Democratic, most likely, assuming everything goes through, a Democratic president. Certainly, it could be a Republican Congress. It could be a Democratic Congress. We don't know for certain yet. There's the two races in Georgia that will have to decide in January. So what does that mean for us? Some of these things we'll talk about in a few minutes. We don't necessarily have an answer of what's going to happen. So we're going to be speculating. Right. And so for clients, when this happened 4 years ago, when President Trump was elected, we knew that there would be tax changes. And we knew that there was things coming. And so we had to make plans in 2017 or 2016 for what we thought was going to happen in 17, and then ended up not happening until 2018. So history tells us that things that we think might happen may eventually happen. I think if you look at the Trump Tax Act changes, they were pretty close to what he said he would do. It just delayed a year. When you go back to President Obama, the tax changes he did from President Bush's tax plan was very similar to what he planned on doing, but it took him 4 years to get there because of the downturn in the economy, all the banking issues. He couldn't really focus on it. He went from having a Democratic Congress when he first started, and then not after that. So it took him a while to get to that point. So it's really I could probably say with certainty at some point that these changes are going to happen. But are they going to happen in 2021? Are they going to happen in 2022? Who knows at this point. So we have to plan thinking for that and expecting that, but we also have to be prepared to understand that maybe it doesn't happen, and we have to weigh those choices at that point.
Right. Thank you for that. So let's dive into some of these specific scenarios. Before I do, Bob, I just want to turn it over to you, and if you could give just a brief couple of words about what the markets are doing right now. We've talked about it, over the last couple of days, honestly, since election night, in terms of what are the markets telling us, that people are thinking right now?
Yeah, I mean, the markets pre-election, we're predicting the results that it looks like is going to happen. It looks like the Senate is going to stay in Republican control. I think that North Carolina the senator is Republican. That was confirmed last night. Georgia, there's going to be a runoff January 5th for both Senate seats. And it looks like at worst, that's going to be a split, one Democrat, one Republican. And is it Alaska is the other one? Yeah, I think it's Alaska is the other one. And that's clearly going to go Republican. So it should be, it should be a split Congress. And the markets like that. The markets like slow, methodical change, debated. It doesn't like quick change. It doesn't like, huge consensus and all of a sudden, there's a big 3 yards and a pile of dust. It doesn't like that. It likes steady, slow and steady and predictable changes. So, and I think that's why the markets rallied going into the election, and they've rallied after the election. And so the markets like what they're seeing. They like what they're seeing. They like a moderate in the White House, and Biden has been presenting himself as a moderate. And then split Congress is fine for the markets. And quite frankly, they're expecting a huge stimulus package in the not too distant future. So markets like it.
Thank you for that. And I wanted to ask you to give that kind of background for a particular reason. And that's because, yes, right now the markets are pricing in a very probable Democrat in the White House and then split Congress. So Derek, let's start with that scenario first, since that seems like the most likely.
Yeah, I mean, if that's most likely, I would figure unless there is some arm twisting, pushing, pulling, we'll see a status quo. We'll talk about the five I have 5 things I want to talk on Biden's tax plan, but I don't see many of them going through because a lot of them are going to affect the Republican base more than the Democratic base. But if you end up with a, like Bob said, with a very almost split House, I mean, if it's it's 49, 49-51 at the end of the day, or I guess it'll be 49-51. I was thinking about the 2 independents. I don't know where they figure out how that works out. 51-48, 50-48 with the 2 independents. You only have to sway 1 or 2 Republican senators to move over to the other side to get what you want. So that's what's scary from a tax planning perspective.
Yeah.
It wouldn't take much for the Biden tax plan to come through because they have a majority in the House. So they know they're going to get that. We know we have a Democratic president who will sign the bill. And so 1 or 2 Republican senators flip, actually just 1. If they get both independents to flip and they get 1 to go, they'll have the majority and they can pass this tax act. So it is. So, when people are saying, oh, there'll be no change, there'll be no change, I can agree with them because you figure everyone's gonna vote by party lines. But if one of the Republicans is thinking about party, the Republicans is in a very conservative, moderate state, New York, California, Florida, or something like that, that might do that. We have a Republican senator, and this is a blue state again. So could he switch on ours? Absolutely. So I could see easily 1 Republican senator switching over. That happens. These five things I'm talking about are very likely.
Okay. So talk us through those 5 things. That's what everyone's waiting for. So let's go.
There we go. Let's go right into them. All right. So the first one, a big piece, is that if you make less than $400,000 as an individual, there'll be no changes to your taxes. And it's going to be status quo. The tax act that was passed by President Trump will stay in play. The tax act will be what it is. And that makes sense. When you look at history, politicians don't like raising taxes, right? They just, it's not a good thing. And so that $400,000 is sort of the Democratic base. When you think about it, that's a lot of Democrats in that place. So raising taxes could be political suicide on those people. And the second part of that, there's not as much actual capital gained or much taxes collected out of that base. And so when you raise the upper brackets, you get a lot of money. When you raise the lower brackets, not as much, and it's politically not such a great thing. So you see that, the Bush Tax Act was in 2001 and 2003, made some significant drops in those lower brackets. Obama came in, he didn't even think about touching that. I mean, he would go out and say the Bush Tax Act wasn't a great tax act for the country, whatever. And it came down and pushed the shove, and he did 1 change and 1 change only in that entire tax. So, I think that, he said this, he stated it. He stated on the campaign trail, he stated in his commercials. I think that's pretty stable. I think you can pretty much count on that. So you make $400,000, you can kind of ignore what I have to say.
So does that apply though to just ordinary income, or would that also apply to, and I'm sure you're going to get into this, but the potential changes in capital gains tax rates or the peel and step up in basis? How does that?
I think that it's going to apply to everything. It's $400,000 adjusted gross income. So if you make $200,000 and you get a $200,000 gain on your Apple stock, tomorrow you'll still be under it. You'll be fine. Everything is above the $400,000 level, and that's kind of we're at the 35% tax bracket. is where that when I married filing joint return is about 35% there. And that's the bracket that always has been kind of hammered left and right between Republicans and Democrats. So
Sure.
35, 37, 39.6 are the three brackets up there that kind of gets bantered back and forth. So,
Okay.
So I think, yes, if you are under $400,000 for all your income, that's adjusted gross income as far as we can tell, then I think you're fine.
Okay. Awesome.
The second piece is the corporate tax rate change. So right now our corporate taxes are 21% across the board. This was, again, another thing in the Trump Tax Act. President-elect Biden has talked about raising that to 28%. It's really not a big issue because most small companies are what we would call S corporations or partnerships. And so most of them don't actually do it. The second piece that it makes it not a big deal is that when the tax act was lowered to 21%, we did analysis on all these corporations saying, would they be better as a C corporation than an S? And time again, it was better for them to be a C corporation for one reason, and generally one reason only. Pennsylvania corporate tax rate is 10%. So when you added the Pennsylvania corporate tax rate on top of their their federal tax rate, they're still being taxed at 31%. And if they get the money out, they'd have to pay dividends, that'd be at 15 or 20%. And suddenly we're at 50+%. And tax never made sense. So we don't have a lot of companies that made that election to be a C corporation from an S when this happened for that reason. So I don't think it's going to affect a lot of people. If you are a C corporation right now, this might be the time to talk about being an S corporation with these increased rates, increased other things. Talk to your advisor about that, what the benefit would be. So, and that's really all I'm going to go into that one because it's not really a big picture item for most people.
Sure.
I think we have to mention it because it's all over the commercials. It's all over the tax plan. If I didn't mention it, we
right. Yeah.
The income tax rate right now will go up to 39.6. And, it's not exactly clear where that break point is. But like I said, he's talked about $400,000. $400,000 in the married filing joint is right at the end of the 32% tax bracket. So that means everything above 32% would jump all the way up to 39.6. That is a little different than in the Obama Tax Act, what Obama did. It's a little different because we were jumping, because in Obama's, he took the 35 and moved it back to 39.6, but that was originally the 39.6 when he did. So this was essentially a bracket that was non-existent, that was created and then would be moved up. That is a big jump. It could be a 7% jump in some ways for some people, depending on where they're going. Certainly 4.6 to 2.6 without a doubt, no doubt about it. For some people who were always in the 32% bracket, they'd see a big jump. So this is one of the tax planning maneuvers we do all the time during this time frame, is that we look at what we should do. And it's when our tax rates are rising, we're telling people to accelerate income into the current year and then push expenses into the next year to take advantage of those people who are in those high tax brackets. Obviously below $400,000, don't worry about it. But if I have a client who's making $600,000, I'm telling him, okay, let's get more income at that 35 or 37%, because we're going to save 2 to 3% in there, 2 to 5% in that bracket. And we're going to take those expenses next year and save 2 to 5%. So that's a big thing. At the end, when President Bush first came to the office 16, we had this conversation with everyone, had them all doing it in before 17, right at the end of 16, when we had our tax plans, and then nothing happened. And then we had them do it again. Because at 18, we then knew that the Tax Act was passing and we had to go through it. So we do it 1 year and another year. We can always redo it again. It doesn't have to be a one-time thing. So we ask clients to do that in that sort of frame. The fourth thing is the Social Security taxes. So right now, when you make more than, I can't remember what the Social Security limit is today, but $150,000, I think that's the new limit, I think this year. The 6.2% FICA tax stops. If you make more than that, you only have to pay the 1.45% Medicare tax. Under President-elect Biden's plan, it would stop at that limit. And then when you made $400,000, it would start again. So if you made $1 million, let's say, that $600,000 would be subject to 6.2%, which it wasn't subject to before. So that's a big difference. That's his idea of how maybe to fund the Social Security Trust Fund that is deemed to be bankrupt in a few years, get money into it, and certainly could raise a lot of money. There's no doubt. People who make stock options, they get hit with that, get hit high income, sort of phantom income a lot of times. So even an average person who works in California or New York, or even Pennsylvania with stock options gets above that level a lot of times because of their stock options. So it would hit a lot more people than you think it would at the end of the day. the key tax planning item out of this one is that if you have an S corporation, if you have a C corporation, you want to move to an S corporation and limit your salary, because S corporation earnings are not subject to this extra amount above the $400,000. Might be subject to the extra income tax. Can't get around that, but we can get around 6.2%. So if I have a client who's a C corporation making $1 million as a W-2, I shift into an S corporation. He pays himself $400,000 as a W-2. That extra $600,000, I just save 6.2% on. And the company saves 6.2, so technically we save 12.4% on. So, as well as local taxes and other taxes. So that's a whole. Being an S corporation is a whole other conversation, but it just became more in play with this piece. And then the final thing is the capital gain rate changes. Certainly, the two things that are not surprising in the Biden Tax Act is the increase in the individual tax rate and this attack of the capital gain rates. Historically, the Democrats have always gone through and kind of attacked these pieces and tried to increase the rates. One of the big things that's in this tax act that's kind of scary in a lot of different ways is that if you make more than $400,000, the piece in that is that capital gain rates will be treated as ordinary income tax. So you go from maybe 100% on that 15 or 20% where you're at to possibly 39.6.
Right.
That's
and from a planning perspective on our end, a huge part of income planning for folks who are retired on their portfolios is, tax optimization, where you take your income from, qualified account, non-qualified account. So, that could definitely have huge repercussions on our end as well for planning.
Right, absolutely. I mean, I think it's going to put a great burden on the financial advisors, as you guys, because if you take a big capital gain and puts them over that $400,000 limit, and they pay an extra, $30,000, $10,000 of tax on it, let's say, they're going to look at, why did you do that, or what was going on? So again, I think it goes to two things. One, we have to be more careful in our communication. We have to be more careful in our planning, because we cannot incur one of those pieces. Again, in planning, I have a client that just sold a big piece of rental property that she had a lot of captured losses under that. So which she wasn't able to take over the course of time. I can now have her, go out have her financial advisor look at her account and say, okay, let me harvest $500,000 of gains, because I can offset them at this loss, and net tax effect is small, and I would say under the 400,000. So we're going to have these planning pieces and have to take advantage of items that happen like that. Take advantage of Roth IRAs, maybe moving in money from a non-qualified, or moving from an IRA to a Roth IRA. Use our non-qualified money to pay the taxes, create this tax-free money, and thus reduce our worry about these capital gains coming through. So there's lots of possible tax planning options, but when there's such a big difference in this, like this, what it was in the past, we really have to get used to it, get careful, plan better, and it will become our normal MO in the sense that when we're meeting about planning, we're going to go, what is those capital gains? Where are we at? We talk about that already, but we don't have to put as much impetus on it. But if we have a client who's making $350,000 as a W-2, and their capital gains are $20,000 versus or $100,000 versus $50,000, now we've got $50,000 that might be in the ordinary tax rate, which in the past has just been the same 15 or 20%. So
right.
So let's say Biden gets his way and he installs all these tax law changes, and that happens at some point next year.
Okay.
What's the chance of him making it retroactive back to January 1st, do you think?
I think it depends on how far in the year we get. There have been histories where we've gotten to May and June and they've done this, and we've had, I don't remember, Bob, we've had split capital gain years where capital gain was done before this date, it was subject to this rate. If it was done after this date, it was subject to this rate. Things like these capital gain items, I could see very much being subject to those split sort of rate scenarios, because I don't see the government wanting to play political hardball with someone about a capital gain they made in February and then having them pay ordinary income tax when they didn't know. So I definitely could see that being a piece in there, because we've seen that before where they've split the capital gain rate based on when you do this, when you do that. Ordinary income taxes, generally they don't split them because it's too hard to come through. With a capital gain, I have a date where I made the sale and it's been reported to the federal government. So they know that. With an ordinary income, I could essentially play with the numbers based on it, because they don't know when you earned your money, when you got your bonus, when you got this or that. So, it could be they would do that and retroactively go to active January 1. But, I think that, again, more often they're happy that the act passes than the actual timing of it. So,
Makes sense.
you see a lot of times these acts don't pass between May and September, even though they're on the table, because they don't want to have to play with that fireball there. They want to they'll pass it off, and then in October, November, they'll pass it for the next coming year, so people have a chance to plan.
Sure.
Okay, so that means we don't have to, likely it's not a good strategy to go back and advise clients to accelerate gains into this year. Probably have plenty of time to do tax planning.
Agreed. But if the rate goes up, then those capital gains could be affected from their ordinary income be rated by capital gains. So, it's really interesting. This capital gain question is a really interesting question for me. I have two clients that are selling different assets at this point, and the sale is broken into two different pieces. And so they have the option of taking the sale all this year, all next year, or splitting it.
Yeah.
Mm-hmm.
And in each case, splitting it is a better tax maneuver for them because they get to take advantage of lesser tax rates and things like that.
Mm-hmm.
If the capital gain rate goes up, or something happens, then it's not as good of a deal. They lose money under it. So I have a conversation. I've had a conversation with these clients prior to the election. Now I have to have a conversation with them post-election and say, look, in one case it's $15,000. How strongly do you feel about saving $15,000 versus possibly risking $100,000?
Mm-hmm.
And I think that's the conversation we have to have with our clients. That if we're thinking of selling something, obviously, if we're thinking of selling something 3 years from now, it's not really what we're looking at. If we're thinking about selling something in 2020 or 2021, we have to have that conversation and say, look, it's going to cost you a little extra to do it now. You might be subject to the extra 5% because it puts you into the higher bracket. But that could be 20% next when we're ready to sell it a year from now. Does it make sense to pay it now, be done with it, and not have to worry about that? Or do you want to roll the dice?
Yeah, that's I'd actually like to dive into this a little more. So that was the perfect question. I wanted to ask you, Derek, in your experience with the clients that you work with, how often in these periods of limbo, basically, when we're waiting to see what will actually happen with the tax laws, how often are your clients, with your help, with your partnership, taking efforts to, make some moves or, accelerate income recognition in anticipation of possible tax law changes versus just waiting to see what happens? What's that ratio look like?
I would say that it's like 75-25. 75% are going to accelerate. 75% because we explain it, they understand it, they understand the consequences. For most of my clients, we're talking about accelerating small amounts, $100,000, $200,000. There may already be in the top tax bracket. So whether we do it this year or next year, it's not going to, it's a time value of money thing. And obviously the value of money right now is pretty low with interest rates being low. So they're willing to take maybe a 0.5% loss in interest for a possible 5% gain on taxes. And if it doesn't come through, they recognize that that's the risk they're taking. Again, I think most clients want to make the smart play at the end of the day, but they have to understand why they're making the smart play. I think whether it's with your help or our help, explaining that to them, they can understand that and they can move forward and make that call. So
yeah, absolutely. Okay, thank you for that. So let's finish off this conversation just by talking about, the opposite scenario where, if we knew that the Senate would stay under Republican majority and there was a huge probability that no tax law changes would be executed or passed, what are the typical year-end tax planning strategies, Derek, that you talk about with your clients and recommend that people tuning in today talk through?
Yeah, I think that the typical things is that we do when we do a tax planning projection, it's like doing a mini tax return for a client without any of the source documents. I always say it's kind of fun that way. And so we're looking at their, do they have a large amount of capital gains? Should we harvest losses? Are there items that we need to purchase at the end of the year for their businesses that we can get a tax write-off today? And because one of the things I say to clients all the time, I don't want you coming to me in January saying, hey, I'm going to buy a $100,000 piece of equipment in January because we just lost a possible deduction today that we're going to have to wait 15 months to take advantage of. So, so we have a lot of conversations about purchases. If they are right on the cusp of a tax bracket, whether they like hold off on putting in income, if they know that they're going to get a big payment near the end of the month, to slow down that payment or slow down their billing, to make sure they don't get it, because they might be, again, if they push themselves into the next tax bracket, it's going to cost them anywhere between 2, 5, 7% more. And so they want to kind of keep themselves out of that bracket. It is a lot of tax bracket manipulation, legal manipulation, let's call it. Whether more expenses, if I have clients that I'm trying to keep in the 24% bracket, that's a big bracket for a married person. And so if I want to try and keep them into that bracket, because it's an 8% jump to the next bracket. So we're going to look at their expenses, their income, their capital gains. If they have businesses, whether they can prepay, if they have a small sole proprietor business, their expenses they can prepay. Taxpayers, generally taxpayers are what's called cash basis taxpayers. So if they have a rent payment that's due in January and they pay in December, they get the deduction.
Mm-hmm.
So we're going to look at those kind of things for these clients to try and figure out what it is and what the cost is or what the benefit is of them doing those sort of things. If they're going to put in income, what it's going to cost them in taxes, and make sure that, and then make sure that their estimated payments are correct, so we don't get hit with the dreaded penalties and interest, because those are just silly money to pay out at the end of the day. We can increase payments by $2,000 to avoid them to pay another $100 in penalties and interest. We'll do that. Work with them.
All right. Do you have any other questions?
No,
Derek?
it's really helpful.
Yeah, Derek,
Yeah.
any other thoughts or anything else you'd want to share with people tuning in today?
No, I think the last thing I would say is this. My conclusion, tax planning is a place that's often overlooked. I can't tell you how many new clients come in our office and say, hey, did you have a tax plan prepared this year? And the response is, what? Or a what? Or what do you mean?
Yeah.
This is the one place, as I said at the beginning, that we can really affect change. And there's money to be saved in long-term planning, short-term and long-term planning when you do this. So if you have a tax advisor, consult that tax advisor, talk to them about planning. It doesn't necessarily need to be for everyone. There's plenty of clients that tell me we don't need a tax plan. I just did a back of the envelope tax plan for a client yesterday. We're just to sure that he was had enough paid in. And so he wouldn't get hit with penalties and interest because he had some job changes, some other things. So, even if it's just a call for 5 minutes or 10 minutes with your advisor to kind of give you that information,
Right.
It's definitely helpful and maybe just a matter of giving you a little more sleep at night because you don't have to worry about it.
Exactly.
Absolutely. We all need our sleep.
Very true. We can't say enough and to that, and echoing your message. I think if there's one moral of the story from this episode, if there's one thing that you guys are all going to take, work with your advisors, talk with your advisors, because you never know, just having a conversation, what information can come about and what planning strategies could come about. So work with your advisors. Derek, thank you so much again.
Thank you guys for having me.
Absolutely. From our experience of working with you, it's always been, best of the best in terms of the sophistication of service and planning that you provide to your clients. And so we really appreciate you time to talk with us today.
Makes our job better and easier.
Absolutely.
We want to make everyone's job better and easier, including ours, by conversation with them in April about their money tax
Absolutely.
in a period of high stress. So
absolutely. So yeah, everybody stay tuned. We'll see, how the results of the election actually turn out. And if you have any questions, want to talk anything through, please do give us a call, 412-261-5966. Derek, what's your number if you wanted to get in touch with you?
412-571-0500.
Okay, so we're here as a resource to you. Please don't hesitate to reach out to us, and we'll see you next time.
All right, thank you.
All right.